Welcome to the Deep Dive. Today we are really getting into the weeds on Coupang's Q3 2025 earnings call. That one dropped right after the market closed.
Yeah, and this one was, well, a bit of a head-scratcher, wasn't it? It really gave us this kind of market contradiction.
Totally.
I mean, you look at the numbers, the company absolutely delivered. Huge earnings beat, revenue crushed it, core profit looked great.
And yet
the stock just got hammered immediately afterward. Big pullback.
That's exactly the puzzle we need to piece together today.
Yeah.
Our goal here is to pull out the key financial beats, look at the strategic story they're telling, and really figure out why. Why did a quarter that looks so strong, on paper, lead to a 5, even 7% drop in the share price?
Right. What was lurking under the surface? What guidance points just completely overshadow all that current success?
So let's start with the good stuff. Set the stage with those headline figures, the ones that actually beat expectations pretty handily.
Okay, so consolidated revenue. It landed pretty solidly between $9.27 billion and $9.3 billion.
Which was above what people were looking for.
Oh, yeah, definitely beat consensus. Most estimates were more around the $9.1 billion, maybe $9.15 billion mark, so a nice beat there. And that translates to really robust growth, 18% year over year.
Okay.
And actually 20% if you strip out the currency effects.
20% constant currency growth. That's significant acceleration.
It really is.
So the classic question then, did that growth come at the cost of profit? Was it, buy growth at all costs?
You'd think so, but no. Actually, quite the opposite happened here. GAAP diluted EPS, that came in at 0.05 cents, just slightly ahead of where most estimates were.
Right.
And maybe more importantly, gross margin expanded. It was up over 50 basis points compared to last year, hitting 29.4%.
Huh. So better revenue, better gross margin.
Exactly. If you just stopped reading the report right there, you'd assume the stock was, taking off, not selling off.
Clearly, the anxiety, the real story is buried deeper. Before we get to those clouds, let's look at the engine room, right? The product commerce segment. That's still the main profit driver for Coupang.
Absolutely. Product commerce, or PC as they call it, is really showing maturity and leverage. PC revenue hit $8.0 billion. That's up a solid 16% year over year.
That's still strong growth to the core.
Very strong. But the real story within PC is the margin. That's where things get interesting. PC gross margin expanded, get this, over 200 basis points year over year.
Wow, 200 basis points.
Yeah, hitting 32.1%. And the segment adjusted EBITDA margin, that also jumped about 200 basis points, landing at 8.8%. So that segment alone kicked off $705 million in adjusted EBITDA.
That is some serious margin accretion, especially for a business that big. What's actually driving that? Is it just getting more efficient, or is the mix changing?
It's really both. They are definitely benefiting from ongoing supply chain optimization. They mentioned accelerating the rollout of logistics automation across their network. That helps.
Makes sense.
But structurally, the bigger driver seems to be the growing mix of their third-party marketplace offering, the one they call FLC, Fulfillment and Logistics by Coupang.
Right, FLC. That's basically their version of Amazon's FBA, where they handle storage and shipping for other sellers.
Exactly that. And when FLC grows faster than their own first-party sales, it naturally lifts the overall PC segment margin. They're using their existing logistics infrastructure, but without taking on the inventory risk themselves.
Got it. Leverage on fixed costs.
Precisely. And it's also worth noting they mentioned active customer growth was about 10%, but they emphasize that most of the revenue growth, that lift, is coming from existing customers spending more.
So deepening the relationship, increasing wallet share, that's a good sign for loyalty.
Definitely speaks to the stickiness of the platform. They also mentioned an interesting operational thing, these reusable eco bags. They're expanding them beyond just fresh orders to general merchandise now.
Okay. Why is that significant?
Well, they see it as helping sustainability, obviously, but also driving operating efficiency. Management seemed to think this could be like a quiet but powerful driver for the P&L down the line.
Interesting. Okay, so summing up the core. It's robust, it's growing, it's throwing off more and more profit and cash, which naturally leads to the question.
Where's all that cash going?
Exactly. If the core is doing so well, they must be putting that money to work somewhere aggressively. And that takes us right to the developing offerings, or DO segment. This seems to be where the short-term pain is really concentrated.
Yeah, DO is definitely where the investment dial is turned up right now. DO revenue grew 32% year over year, hitting $1.3 billion.
Yeah, what's in DO again? Eats and It's.
Primarily Eats, their food delivery business, and the really big focus right now, the Taiwan expansion.
Right, Taiwan. That's
Yeah.
the one showing that crazy triple-digit growth everyone's talking about.
That's the one. Management sounded extremely bullish on Taiwan during the call. They specifically pointed out that the customer adoption rates, the retention levels, they're tracking almost exactly like the early days in Korea.
Which were incredibly successful.
Incredibly successful. So when management says that, they're signaling huge confidence in the long-term potential there.
But, and here's the rub, that high confidence, that strong early traction, apparently translates directly into needing more investment now. And that seems to be the specific thing that spooked the market.
That's precisely it. Confidence costs money, especially up front. The DO segment reported a pretty significant adjusted EBITDA loss of $292 million just for this quarter.
Ouch.
Yeah. And then came the guidance shocker. Management actually raised the full-year loss guidance for the DO segment. They pushed it towards the high end of their previous range, which was $900 million to $950 million.
Wait, they guided for a bigger loss?
Exactly. And they explicitly tied it to the strong momentum, especially in Taiwan, saying it requires higher, more front-loaded investment to capture the opportunity.
So let me get this straight. The stock dropped because management basically said, our big growth bet is working even better than expected, so we need to spend more money on it right now.
Pretty much. It's that classic growth stock paradox, isn't it? The market sometimes punishes near-term success if it comes with a higher price tag today, even if it signals better long-term returns.
It's wild. But that wasn't the only thing dragging down the reported numbers, was it? There was that whole tax situation, too.
Oh, yeah. Can't forget the tax rate. That's a major, though likely temporary, drag on the reported GAAP earnings. The consolidated results included this projection for a full-year effective tax rate of something like 60% to 65%.
60 to 65%, that's huge.
It is. Now, they expect it to normalize longer term, maybe around 25%. But having a 60% plus effective tax rate hanging over your reported profits right now, well, that's a pretty big psychological hurdle for investors focused on the quarterlies.
Okay, and digging into that Taiwan strategy a bit more, it sounds like they're basically just running the Korea playbook all over again, right?
Yeah.
They're not changing course despite the upfront cost.
Nope, sticking to the script completely. The investment focus is exactly what they did in Korea. Scale up the first-party product selection, roll out the third-party marketplace, that profitable FLC model, and, crucially, build out their own dedicated last-mile logistics network.
The moat.
The moat. Management was upfront saying the path won't be, a straight line up. There will be bumps, but they sounded absolutely convinced about the long-term potential for really attractive cash flows, just like Korea delivered.
So it really brings us back to this core tension, this kind of narrative battle driving the stock. You've got the mature, highly profitable core PC segment
Churning out cash.
versus this accelerating but still heavily cash-consuming innovation engine in developing offerings, mostly centered on Taiwan right now.
And management's trying to bridge that gap. Their view seems clear. They still expect the overall consolidated margin to keep expanding, but on an annual basis, they're basically saying, look through the quarterly noise.
Right, acknowledging the quarter-to-quarter swings because of things like weather, seasonality, and just the lumpiness of these big DO investments.
Exactly. But the annual trend, they believe, is still upwards for margins, even with Taiwan soaking up cash.
Did we hear anything encouraging about maybe costs starting to ease up elsewhere, like the underlying tech spend?
Actually, yes. That was another interesting nugget. They indicated that technology investment spending, which you usually see in the OG&A line as a percentage of revenue, it's starting to taper off a bit.
Okay, why is that significant?
Well, it suggests that the really heavy lifting, the big build-out phase for their core tech infrastructure, might be winding down. And if that's the case, it should provide another tailwind for those PC margins long term. They reiterated that goal of getting PC margins well past 10%. Tapering tech spend helps get there.
Good to hear. And they mentioned AI too, not just as a buzzword.
Yeah, they framed it as a core operational tool, delivering real benefits already in things like demand forecasting, warehouse automation, delivery routing, concrete stuff that should help the P&L going forward.
Okay, and quickly on capital allocation, they are buying back shares.
They are. They repurchased about $81 million worth of shares in the quarter. It's not huge relative to their market cap, but it's a signal, right? Management saying, we think the stock's cheap down here, and it helps offset some dilution.
Right. So for anyone watching this closely over the next, say, 6 months to a year, what are the key things to look out for, the catalysts?
It really all comes back to Taiwan. You want to watch for any updates on how quickly they're signing up merchants for the marketplace there. You want to see KPIs around their last mile delivery network. How quickly are they building it out? What's the penetration? And critically, you need to see signs that the DO segment loss, that big negative number, has actually peaked and is starting to flatten out or shrink. That's the inflection point the market's waiting for.
Okay, that makes sense. And that focus on the Taiwan execution versus near-term cost sets us up perfectly for our, let's call it our strategic thought experiment segment.
Right. And let's be absolutely crystal clear here. This is not financial advice. We are definitely not telling you what trades to make. This is purely taking the strategic narrative from the earnings call and spinning out a, let's say, plausible, if maybe a bit ambitious, thought experiment around it.
Got the disclaimer out there. So the core idea stems from that paradox we discussed. The stock dropped because management signaled more confidence and faster progress in Taiwan, which meant higher near-term costs and that temporary tax hit.
Right. The market focused on the immediate pain.
Exactly. So could you structure a trade that basically plays on that disconnect, betting against the market's short-term fixation while aligning with management's long-term conviction?
Okay, walk us through this multi-layered idea.
So the thinking goes like this. The market right now is obsessed with the next, say, 6 months, the high DO losses, that ugly tax rate. You could try to capitalize on that near-term pessimism, maybe by selling some short-dated, out-of-the-money call options.
Okay, collecting premium based on the idea the stock stays range-bound or lower in the near term, monetizing the skepticism.
Precisely. But then simultaneously, you take that premium or other capital and you make the long-term bet. You'd purchase deeply long-dated call options, maybe 18 months out, maybe even further.
Ah, so using leverage for the long game.
Exactly. That long-dated call purchase is purely a bet on one thing: the successful execution of that Korea playbook in Taiwan, specifically building out that last-mile logistics moat. If they pull that off, then whenever the market finally believes the DO losses have peaked and are improving,
The stock should see a massive re-rating.
that's the theory. The long-dated calls could pay off significantly if Taiwan becomes the next Korea for them, completely overshadowing the cost of the short-dated options sold earlier.
It's a classic kind of pairs trade structure, in a way. You're short the near-term noise and volatility, and you're long the multi-year strategic execution story. Plausible, definitely ambitious.
So wrapping up the Q3 2025 story for Coupang, the core business showed durable growth and really impressive margin expansion. But that positive story was just completely overshadowed, at least in the immediate market reaction, by the higher spending needed for the high-growth new areas, especially Taiwan, and that temporary but significant tax rate headwind.
Which leaves us and you, the listener, with maybe one final provocative thought to chew on. Management is clearly betting the farm, metaphorically speaking, that these big investments in Taiwan are just history repeating itself, an echo of their incredibly successful Korea launch. But given that they had to raise the loss guidance because things were going well, is that higher than expected cost truly just the price of accelerating success? Or could it perhaps be a subtle sign that maybe the competitive environment in Taiwan is just a bit tougher, a bit more frictional than what they faced back in the early days in Korea?
That's the multi-billion-dollar question, isn't it? Is it just faster spending on a proven path? Or is the path itself slightly rockier this time around? Answering that really determines the long-term value here.
Indeed, it does.
Something to think about. Thank you for joining us for this deep dive into Coupang's quarter.